Before diving into technical indicators and trading strategies, it's essential to understand how price data is visualized. Charts help traders interpret market movements, and among them, candlestick charts are the most powerful and widely used. In this chapter, we'll introduce the three main types of charts, explain OHLC data, and decode the language of candlesticks, the building blocks of technical analysis. Line chart connects the closing prices of an asset over time. Simple and clean, it gives a general sense of trend direction, but misses details like intraday highs-lows. Bar chart, OHLC, displays four pieces of information: the opening, high, low, and closing prices of a time period. More detailed than line charts. Candlestick chart is the most popular chart type. It visualizes the same OHLC data but in a format that's easy to interpret at a glance. Every bar or candlestick represents four values over a specific time frame. Open is the price at the start of the period. High is the highest price reached. Low is the lowest price reached. Close is the price at the end of the period. Together, these 4 points form the skeleton of every technical chart. A candlestick has two main parts. The body represents the range between the open and close. Green, white if close higher than open, bullish. Red, black if open higher than close, bearish. The wicks, or shadows, represent the high and low of the session. Each candle reflects a specific time frame depending on the chart settings. A 1 hour chart equals sign, each candle shows 1 hour of price action. A daily chart equals sign, each candle represents one trading day. Traders choose time frames based on their strategy. Short-term traders often use 5-minute or 1 hour charts, while long-term investors use daily or weekly charts. Doji has open and close that are nearly equal, suggests indecision. Hammer has a small body with a long lower wick, potential reversal after a downtrend. Shooting star has a small body with a long upper wick, possible bearish reversal. Engulfing pattern is when one candle fully engulfs the previous, strong momentum signal. These patterns are simple yet powerful when read in the right context. Charts are the visual foundation of technical trading. Candlestick charts are preferred due to clarity and detail. OHLC data provides a complete picture of each period's price action. Learning to interpret candlestick types is the first step in mastering chart reading. Next up, in Chapter 2, we'll explore support and resistance, the invisible levels that guide price action and form the backbone of technical analysis. Support and resistance are the backbone of technical analysis. These invisible levels act like magnets and barriers for price. Support prevents prices from falling further, while resistance keeps them from rising. In this chapter, we'll break down what support and resistance are, why they form, how traders use them, and how to spot them on a chart. Support is a price level where buying interest tends to emerge. It's often seen as a floor that supports the price from falling further. It forms after a downtrend slows and demand increases. Traders expect price to bounce at this level. The more times price touches support without breaking it, the stronger the support. Resistance is a level where selling pressure typically appears. It acts as a ceiling that prevents prices from climbing higher. It forms after a rally where sellers begin to take profits. Traders expect price to reverse or stall at this level. Like support, repeated tests without breakouts strengthen its credibility. One of the most powerful concepts in chart reading is that once support is broken, it often becomes resistance when price retraces, and vice versa. This happens due to psychological memory. Traders who miss the move jump in when price revisits the level. It creates great entry or exit zones. Static levels refer to horizontal lines, usually based on previous highs and lows. Dynamic levels include moving averages, for example 50 or 200-day, trend lines and channels. These adjust over time and provide dynamic support resistance. Entries are made by buying near support and selling near resistance. Stops are placed just beyond support resistance to manage risk. Breakouts, a strong break above resistance, signal bullish momentum, while a breakdown below support signals bearish momentum. Confirmation through volume spikes or candlestick patterns. For example, engulfing hammer around these levels improves reliability. Support and resistance levels help identify potential price turning points. They form the basis for many trading strategies and risk controls. Role reversals offer powerful setups for breakouts or reversals. Combining S and R with patterns or indicators increases accuracy. Next up, in Chapter 3, we'll look at chart patterns like triangles, flags, and head and shoulders, and how they signal market psychology in motion. Chart patterns are visual footprints of market psychology. They represent collective investor behavior and sentiment, fear, greed, indecision, or conviction playing out in the price. In this chapter, we'll explore the most common chart patterns, what they suggest, and how traders use them to anticipate price movements. Patterns represent periods of consolidation, continuation, or reversal. They help traders gauge the next possible move with better risk-reward setups. They don't guarantee outcomes, but offer statistical edges based on repetition. These patterns signal a possible change in trend direction. Head and shoulders indicates a shift from uptrend to downtrend. Left shoulder, head peak, right shoulder. Breakdown below neckline confirms the pattern. Inverse head and shoulders, bullish reversal after a downtrend. Double top bottom, 2 consecutive peaks or troughs around the same level. Suggests rejection of a continuation. These suggest the prevailing trend will likely continue. Triangles formed by converging trend lines, breakout direction gives signal. Flags and pennants, short consolidation after a sharp move, often resolve in trend direction. Rectangles, sideways range, breakout confirms continuation. Reversals indicate exhaustion or rejection of prior move. Continuations represent temporary consolidation before next leg. Patterns are visual representations of accumulation, distribution, or indecision. Entry after breakout from pattern, for example, triangle or neckline. Stop loss below pattern support. Target often measured by pattern height projected from breakout. Example, a triangle with a $10 height might target $10 upside from breakout point. Chart patterns offer insight into trader psychology and market behavior. Reversal patterns warn of potential trend changes. Continuation patterns support trend following. Patterns become more reliable when confirmed by volume and momentum. Combine patterns with support, resistance, and candlestick analysis for optimal setups. Next up, in Chapter 4, we'll look at technical indicators, including RSI, MACD, and moving averages, and how to use them effectively in your trading strategy. Technical indicators are tools that help traders interpret price behavior and make data-driven decisions. While they are not magic signals, when used correctly, indicators can support trend identification, timing, and confirmation. In this chapter, we'll explore 3 core indicators: RSI, MACD, and moving averages. These tools are simple to learn but powerful when applied with discipline. RSI measures momentum by comparing recent gains to losses over a fixed period, usually 14 days. It is expressed as a value between 0 and 100. Common interpretation: above 70 means overbought, potential reversal or pullback. Below 30 means oversold, potential bounce. Use case: if a stock is in a downtrend and RSI crosses below 30, it may be due for a reversal, especially near support. MACD is a trend-following indicator based on moving averages. It consists of three elements: MACD line, difference between 12 EMA and 26 EMA, signal line, 9-period EMA of MACD line, histogram, distance between MACD and signal line. MACD crossing above the signal line indicates a bullish signal. MACD crossing below the signal line indicates a bearish signal. Histogram shows momentum strength. Moving averages smooth out price action to help identify trend direction. Simple moving average, SMA, average closing price over fixed periods. Exponential moving average, EMA, gives more weight to recent prices. Popular setups, 50-day and 200-day MAs for trend analysis. Golden cross refers to the 50 MA crossing above the 200 MA bullish. Death cross refers to the 50 MA crossing below the 200 MA bearish. Dynamic support or resistance. MAs often act as support in uptrends and resistance in downtrends. Avoid relying on a single indicator. Combine RSI, momentum, plus MA, trend, plus MACD, timing or confirmation for robust signals. Example, look for bullish RSI plus price above 50 MA plus MACD crossover. They lag price based on historical data, can give false signals in choppy markets. Best used in conjunction with price action and support or resistance. RSI shows overbought or oversold conditions, useful for reversals. MACD is excellent for spotting trend shifts and momentum strength. Moving averages help identify and follow trends and act as dynamic S or R. Combining indicators improves signal reliability. No single tool should be used in isolation. Next up, in Chapter 5, we'll bring it all together and explore how to build a simple rule-based trading setup using charts, indicators, and structure. A trading setup is a defined framework that helps traders make consistent, repeatable decisions in the market. It combines price structure, indicators, and strategy logic into a rule-based approach that eliminates emotion and guesswork. In this final chapter of Module 2, we'll show you how to build a simple but effective trading setup using the tools you've learned. A trading setup is a repeatable situation that signals a trade opportunity when certain technical conditions are met. Key components, entry criteria, exit criteria, stop loss and take profit, position sizing, confirmation indicators. Let's walk through a basic setup for trading in the direction of the trend. Example rules: trend filter, price is above the 50-day EMA. Momentum signal, RSI is above 50 but below 70. Entry trigger, MACD line crosses above signal line. Stop loss, below recent swing low. Take profit, 2x risk, or when RSI reaches 70. This creates a repeatable structure for identifying and executing trades. Before applying your setup with real money, backtest. Apply the setup to historical charts to see how it would have performed. Demo trading. Use simulated platforms to build confidence and tweak parameters. Keep a journal to track setups, outcomes, and improvements. Always respect your stop loss and target. Avoid moving stops based on emotion. Don't take random trades outside your setup. Discipline is key. No setup is universal. Adapt based on your personality and time horizon. Scalpers versus swing traders will use different triggers and tools. Review performance monthly and improve your strategy. A trading setup defines your actions ahead of time and removes emotion from trading. Combine indicators like RSI, MACD, and MAs with clear entry-exit logic. Backtesting and demo trading are critical before going live. Success is not about predicting, it's about executing a tested edge consistently. Next up, in Module 3, we'll shift focus to fundamentals and macro analysis, understanding the economic and company-level forces that shape market behavior.